this training, we're going to cover the Oregon Realtors Form 1.1 on the residential sales agreement. This is the 2025-1 edition of the form, which you'll see on the bottom of the form. Down towards the base of each page, it will tell you what edition of the form you're looking at. And in this case, we're going to cover the first set of updates that occurred in 2025. The sales agreement form itself is used to facilitate a contract. It allows you to transfer the sale of property. Sales agreement itself is the centerpiece to the contract, and then you would add addendums to it as essentially spokes to a hub. This allows you to modify away from the central document, then apply whatever terms you need for your transaction. In the Oregon Realtors library, this is Form 1.1. Our forms are numbered with similar nomenclature. So Form 1.1 is the residential sales agreement, 1.2 is commercial, and so on and so forth. The 2s are addendums, the 3s are disclosures, and so on and so forth, as you see on the left-hand side of the screen. These are the ways that we number our forms. The actual sales agreement itself begins with a final agency acknowledgement. We'll skip over that for now. It essentially is just a way to state exactly which agents are involved in the transaction. It's required by administrative law. The form will be the same on every transaction you look through because it's required through administrative rules. What we're actually going to follow in the sales agreement is the first section. The sales agreement will always have that acknowledgement at the beginning, and the actual document begins on the technical second page, but that's where we are right now. The second page is most of the primary inputs of the transaction. We've arranged the documents that it has 3 distinct sections. The first is the primary inputs. It's the sales price, it's the closing dates, it's the purchase price, and all of the fixtures and addendums and whatnots that you would add to the transaction. This is the majority of the input that you'll put in a sales agreement. Most of the writing you will do happens in this section. The next segment begins a couple pages later, and it's the time frames. This is all the things that have to do with a time period. You have 10 days to do the following act. You have a day to respond in the following way. If anything involves a number of days, it happens in the second chunk of the contract, time periods section. It is worth noting that the time frames in these segments are defined either as a business day or as a calendar day. Business days is a defined term. Later in the contract, we'll get to the definition section, but just know that there is a full definition. It's a day that's not a holiday, it's a day that's not a weekend, and it's a day that's not governmental holiday, so a federal government closure holiday. A calendar day, by contrast, is just any day that is on a calendar, so any day that ends in Y is a calendar day. The third chunk of the contract happens a little later on, and this is essentially just all the rest, the general terms sections. There are no inputs that a broker is going to make in the general terms section. These are the load-bearing walls of the contract. Essentially, you don't want to modify these provisions because they provide the foundation for the contract. It defines closing, it defines termination, it states that you are able to do assignment or not do assignment. These are the pieces that are essentially locked into the contract, and you don't want to change it without an attorney's input. You can change these provisions, but you want to have it be something that an attorney has some sort of a guidance around, because you might move something rather important within the contract and it could cause other pieces of the contract to fall apart. So we don't advise changing anything from this section onwards. When you get to the very end of the contract, there's a little piece where you're able to put in signatures and dates. And this is technically the last input that you make as a broker. It begins with when the buyer's offer valid for, when it expires, the deadline. You have a space for the buyer to sign the document, a space for the seller to state that they accept, reject, or counter, and a space for the seller to sign if they do so accept. With the way that we've got these contracts set up, the offer deadline is a hard and fast line. If you are trying to accept an offer after it has expired, that will not work as an acceptance, and instead there's a separate document called Form 2.3 that you would use in that scenario that it allows you to accept an offer after it has expired. It is functionally just a pre-drafted counteroffer that addresses the problems that can occur when an offer has expired. You can also just counteroffer to create a new offer after it's expired, but we would encourage use of Form 2.3 as it's pre-drafted for the specific purpose. From here, we're going to go back through the contract and cover specific sections one by one. I guess it's worth noting before we go there, the final section of the contract is the delivery and presentation section. It's informational only. It is not something that has to be filled out. It is functionally just there to assist your principal broker in their document review, so they'll know exactly when this document was presented to your seller. Now, if we go back to the top of the sales agreement, the first section has the property description. This should simply be a identifying property description. If it is sufficient for identification, that's all you need. It's just to make the parties aware of what property is being sold, what county it's in. Now, if a property description is not enough to identify the property, you may need more input. There's space for that. This would occur, for instance, if you have a property that's in multiple parcels that have the same mailing address. Times you'll have, for instance, a large field that is all the exact same mailing address, even though it is 4 separate parcels. And if you're selling each of those individual parcels, you may need more description to tell the buyer you are only buying the southeast parcel. You're not buying the whole thing that is at 123 Rural Avenue or wherever the property ends up being. So this is simply informational. The purpose, what you should put in this section, is simply enough information that parties can identify the property. When you actually write the deed, you'll use the legal description from the title company that is provided to you. But in this segment, it just needs to be merely identification worthy. The next section is financial terms. This allows the parties to set the price and to establish all the various payments. It has spaces for the parties to call out various funds that are not presently available, such as contingent funds or non-liquid funds. You would essentially begin with your purchase price, and then you could specify whether there are objects within that purchase price that the buyer does not currently have. So, for instance, if the buyer is purchasing the property, but a portion of their purchase is being funded through the sale of their stock portfolio or liquidation of a 401k account, that is money the buyer doesn't presently have, and that needs to be defined within your offer as a buyer. You need to tell the seller, I am willing to offer X number of dollars to purchase. However, a certain chunk of that money I don't have yet, and I'll have to do something else before I have it. This does modify the buyer's offer in the seller's eyes. If a buyer says, I'm willing to buy your house, don't worry, I have a Bitcoin wallet, I can purchase it. That Bitcoin wallet might not be worth enough money to purchase the property in the future because it's a very volatile asset, and that can change the seller's opinion of whether this is a good or a bad offer. And so it needs to be specified if you have non-liquid or contingent funds, and those are defined later in the contract. Underneath the non-liquid and contingent funds section, you have a portion where you can specify if there is some sort of a seller payment of the buyer's agent. You would have a checkbox where you can state the seller is going to provide a payment that will be used to pay the buyer's broker, and you can specify that amount. Beneath that checkbox on line 4G, you have a checkbox that states that the seller agent is willing to offer a portion of their compensation to the buyer agent, and that agreement has already been established. If it is the process where the agent is offering it to share their commission or split their commission with a buyer agent, that is something that is handled between the brokerages outside the sales agreement. The sales agreement is between the buyer and seller. The agents are not parties to this sales agreement. You are assisting the buyer and the seller. And so a provision within the contract that states seller's agent will do the following has no effect on a seller's agent. You're not a signatory party. And so if there is a split of compensation that occurs between a buyer and seller agent, you would handle that separately in a separate contract. Below that, there's a totaling line where you can add up the checkboxes for what the buyer agent is being paid from the seller or the seller agent. That number on that total line should never be greater than the amount in your buyer representation agreement. If it is, it would potentially violate MLS rules. Lastly, there's a chunk at the very end there that allows you to put in a concession that buyer is being offered from the seller. If the seller is offering to pay for carpet cleaning, if the seller is paying for a home warranty, whatever it ends up being, the seller can add that value in on that lowest line, blank line there. There is an asterisk at the bottom of the financing terms section that specifies that the seller agent commission split is only informational within this contract. It is not binding. There must be a separate agreement if there is some sort of commission split that occurs. The parties can specify how the property is going to be transferred, if it's going to be something that uses a deed or if it's going to be seller carried. If it's seller carried, there might be a promissory note in the deed of trust, or there might be a land sale contract that will modify the way that the actual transfer of property occurs. In either of those cases, there's a special document that helps guide that, which is Form 8.1. You can specify the closing and the possession date. The closing date and possession date should be the same. If they're different, there are documents to assist with it. So for instance, if the closing date is on the 15th and possession date is on the 30th, 15 days later, there will be a document that allows you to accommodate the seller remaining on the property for 15 days after closing. Simultaneously, if there's a transaction that has closing date that's on the 30th, but a possession date of the 15th where the buyer moves in before closing, there's a separate document that facilitates that buyer occupancy of the property before closing. In either case, you can set up the prorations based on a specific time frame of the party's choosing. Does it occur at closing? Do you prorate costs and utilities and whatnot based on the possession date or some other date? Parties can make the decision as they choose. There is a special section for you to specify whether you have fixtures or personal property that is going to move in different ways than the normal flow. Typically in a transaction, all fixtures, things that are attached or permanent parts of the property, are so integral to the usage of the property that it has to stay there. Those items stay with the property. So, for example, a chandelier that's bolted into the ceiling, that is a fixture and will remain a fixture with the property. When the buyer buys the house, they also buy the chandelier. Whereas personal property, tractor in the backyard, if you buy the house, you don't get the tractor. The tractor has wheels, it can move. It's personal property. It belongs to the seller. They can take it with them as they leave. Now, you can make specifications that go in the other direction. If the seller wants to keep the chandelier, they can specify that. Buyer, I am excluding the chandelier. I'm going to unbolt that thing and take it with me. It belonged to my grandmother. It came from Europe and we want to keep it. Alternately, you can say, buyer, you get to keep the lawnmower in the backyard. I'll leave it there in the shed when you buy the house. That's personal property that's included in the transaction, but you need to specify those items that are moving away from the normal flow of a transaction. There are some sections that will link you to special forms, other forms that accommodate very specific scenarios. Those are all the ones highlighted here. As you can see, there's bolded language, use form 2.16, use form 4.1, use form 7.2. It will tell you specifically the form to use. Many of these form platforms, your SkySlopes and your Zip forms, will automatically attach those items if you check that box, but it's not guaranteed. So always check your file and make sure you have the documents that you need. If you say that there is a well on the property, you need to make sure that the well addendum is also in the packet of documents being filled out for that offer, because the well is part of the offer itself. All the information about the well, the buyer's review period, the timeframes that you're going to apply for potential well remedies if something goes wrong, you want that to be part of your offer. And so if there is a bolded language that says, checkbox, yes, use form 4.1. If you check yes, make sure you have the bolded form 4.1 that comes with it. There's also an area for extra information, additional provisions as needed. You can put in extra minor details as needed, or you can use this section to say, see general addendum form 2.2. You can specify out to another addendum that allows you to then incorporate more language that wouldn't otherwise fit in those lines. If you have a contract that has some very specific and very complex thing that's going on with it, you might want to put that in a general addendum. And you can use this additional provision section to essentially highlight, send up a road flare and say, hey, seller, be aware there is an additional addendum to this transaction document that is going to cover some really specific and complicated stuff. And I want you to know that it exists. It shouldn't be something that just is at the back end of the contract. You should know about it here in the early parts of our contract. Within the timeframes section, we begin with a provision called counting time. This is sort of a general explanation of timeframes. It explains that time is calculated based on the property's time zone. This will generally be Pacific zone, but there are some parts of Oregon that are on mountain time, specifically in Malheur County. So just be aware where the property is, its time zone, that decides the timing of your contracts. When it says 5 p.m., we mean 5 p.m. in the time zone of the property's location. If there is a time frame that says a party has a certain number of days to do something, you have 5 days to review the title report, something along those lines, that time frame will begin on the next business or calendar day after this contract is accepted, after mutual acceptance, or after a triggering event. So for instance, with the title report, a buyer receives the title report, that is the triggering event. The buyer then has 5 days to review the title report. When the title report is received, the next full business day is the first day of the buyer's 5-day period. What this essentially means is if you are giving someone an offer and it is mutually accepted, you'll start your timelines the next day for most of the timelines. And for things that trigger upon other specific events, those trigger upon whatever that event is the next day after the event occurs. Be aware it will specify within this contract at all times whether you are dealing with a business day or a calendar day. So always pay attention to whether it says business or calendar day, because that can have a very material impact. For instance, over the Thanksgiving holiday, there are several business days that don't occur within that week, but they are all calendar days. So if you have a contract that is happening right around the time where a holiday is occurring, pay attention, because business days will not be happening as fast as calendar days will during holiday time. We next have a section that states specific dates control. This is the safety net provision that is in the contract, but we don't encourage brokers to rely upon it in abstract. What this essentially says is if you have a provision that states you have, for example, checkbox 3 business days or checkbox blank business days, you can check either of those boxes to provide that timeline. It'll be 3 business days or whatever you write into the blank line. If you accidentally leave that section blank, Or if you somehow check both boxes and have something entered in for all of those options, we will use a contractual default that says the first box, the pre-drafted language, will always be what controls. So if I have a provision that says I have 5 business days or blank business days, and I checked both boxes and said 5 business days, check, and 10 business days, check, we are going to default to the first one to resolve the ambiguity based on this specific dates control section. Similarly, 5 business days, checkbox, or blank business days, checkbox, and I didn't check either of those, it will default to 5 business days. We don't encourage this because it's not necessarily the best look for a broker to leave things blank. It is best practice to actually fill out the contract with the intended timelines. If your client says, I want 5 days for that, check the box that says 5 days. It very much affirms that it is 5 days exactly that you're dealing with. This is an example of one of those sections that is controlled by the specific dates control section. So if, for instance, it was left blank like it presently is, we would default to the first checkbox as our option that is selected through contractual automatic process. Similarly, if you had written something in, we would also default to the first checkbox through the automated process of the specific dates control section. The earnest money provision provides the entire path for what you do if there's an earnest money deposit that fails. It essentially says you have X number of days to provide your earnest money after mutual acceptance of the contract. Once you are under contract with the buyer has X number of days to provide their earnest money. There are 2 ways for the earnest money failure to move. We've created a 2-prong approach for what happens when the buyer does not bring the earnest money. The first option is if the buyer fails to provide the earnest money, the seller can send what is called a notice of default. The notice of default tells the buyer, hey buyer, in the contract, you agreed to provide your earnest money within this timeline. I'm going to give you some extra time. I will give you a cure period, an additional set of time to provide your earnest money. If you fail a second time, I have a right to go to small claims court and recover the intended earnest money sum. So you've been put on notice, expected to follow the contract that you signed and agreed to. And if you do not follow through, I will potentially pursue you for the intended sum, even if it's not in escrow yet. Alternately, there's a separate path, which is within the first couple days after an earnest money fails, then 2 days after the earnest deposit is not deposited within the timeline it needs, the seller can simply terminate, move directly to termination. They don't get the earnest money back. We'll refund it to the buyer if any was put down, but the seller can immediately terminate. Now, the difference here is if the seller immediately terminates, they don't have to wait an additional cure period, but they don't get the option of potentially pursuing the earnest money. In a fast-moving market where the seller has backup offers, they may not want to give the buyer a chance to cure and may want to simply move on to the backup. Within that 2-day period, you can go straight to termination, just move on with the contract. Alternately, if you don't have other options and this buyer is potentially something that's important and the seller is expecting to potentially lose something as a result of the time they have lost with this buyer waiting for their earnest money to be deposited, the seller may want the earnest money, and that's the benefit of being able to use the notice of default. Now, as a baseline, you only have the ability to terminate within a short period of time after your earnest money deposit window closes. That means termination right, use it fast. At any point after that, you can send the notice of default. So if the seller wants to give the buyer an additional period of time, they want in good faith to let the buyer maybe have that chance to provide earnest money, and they don't mind waiting, you can always send your notice of default at a later point. But if you want to move on and terminate, it has to happen within a very short window. The next section is buyer's representations regarding financing. This section essentially only applies if the buyer is using a loan, and it lays out several things that we assume the buyer is going to do. We assume that they will be able to pay the down payment. We assume that they're not using contingent or non-liquid funds unless they've specified that earlier in the contract. If the buyer is selling famous art, and that's the way they're going to finance this transaction, selling their cryptocurrency, and that's how they'll finance this transaction, the buyer should have told the seller at this point. If the buyer, for instance, is using non-liquid funds, something, a contingent fund, a gift from an aunt or an uncle, they have a family member that's going to give them enough money that they can make their down payment. They need to specify that earlier in the contract. If they do not specify that, it's considered a failure, a breach of this representation that exists in this section. Essentially, by signing this contract, the buyer guarantees that they are not using contingent or non-liquid funds unless they've already told the seller of this fact. The buyer is similarly prevented through this section from changing their lender or their loan without seller approval. When the seller signs a contract with the buyer, they are expecting very specific provisions as written in the contract to be held to. When the buyer says, I am getting a loan from the following loan provider, a big bank that's very trusted, the seller is expecting that. If the buyer suddenly changes their mind and goes with some very small and sketchy loan program, that's a very different proposition. And it may be considered something that has induced the seller into this contract through essentially a lie, through fraud or misrepresentation. And so the buyer is not permitted to change their loan or their lender unless they ask the seller and get their permission first. There is an additional section in here where the buyer can state that they are pre-approved and they can provide their pre-approval letter. If the buyer is pre-approved but did not provide the letter with their offer, this section gives the buyer an additional period of time to provide that pre-approval. Sometimes this happens when the buyer is trying to get the pre-approval letter. Don't encourage you necessarily to use it in this context because you would be saying that you are pre-approved but you haven't provided the letter yet. What this section exists for is the situation where a buyer is pre-approved for a very large sum of money and the house is not worth the very large sum of money. In that case, it's not necessarily a good move for the buyer to send a pre-approval letter that says, I have $1 million just waiting to be used if the house is not worth $1 million. In some cases, the buyer wants to go back to the lender and say, could you write me a pre-approval for what the purchase price of this property is? It's worth $550. I want a pre-approval that says I'm pre-approved up to $550. Because that doesn't show my hand and explain exactly how much money I have available within my loan process, and it makes my negotiation a little more buyer favored. Not all buyers need to use this provision. Not all pre-approval letters are going to be working in that way, and not all buyers necessarily want to try and hide the ball with that pre-approval letter. But if the buyer does wish to, this section allows the buyer to facilitate essentially a delayed delivery of the pre-approval letter. There is a process later on where once the buyer is under contract, they need to provide an intent to proceed. And that means exactly what it sounds like. It is not technically a defined term. It is simply a buyer has shown that they intend to proceed with the loan. This functionally means the buyer just provides the seller with some proof that they have told the lender, I'm under contract and definitely want to move forward with my loan. The problem we are trying to address with this section is the scenario where a buyer gets under contract, you get far into your sales transaction, and then the buyer goes, oh, I forgot to tell my lender that I wanted the loan. Let's start that process. Lenders take time, and sometimes forgetting to tell your lender that you got a contract accepted and want to proceed with the loan can cause extreme delays in the transaction or even can cause problems where the contract will terminate. And to address that, you want the buyer to make that very clear to the lender and show the seller that they've made it clear to the lender that we're already moving forward with the loan process. There's a financing contingency section that creates a multi-step dance for what happens when a loan fails. This is all assuming that a buyer is using a loan. If the buyer is not using a loan, this section doesn't apply. But if there is a loan involved, this is what happens when the loan fails, when there's a death of a transaction through the loan failure. The first step would be the buyer gets notice from the lender, where the lender says, buyer, you have failed to qualify, or your property you want to buy failed to qualify for this loan, or it appraised too low and this loan is not collateralized enough by this property. Essentially, I, the lender, don't want to give you a loan anymore because I don't think it's worth my time to invest in this property through your mortgage. If the buyer gets that notice, that usually is a death knell to a transaction, but not always. But at that moment, the buyer has two options. They have to tell the seller that the loan failed. That is going to happen no matter what. The buyer will have 2 days after the lender tells them your loan is not going to work. They have 2 days to tell the seller. And with that telling the seller, they can also say, my loan failed and I need to terminate. No problem, no questions asked. Earnest money goes back to the buyer. Your loan didn't work. I'm sorry. Please have a good day. Hopefully someone else will buy the house. If that's the case, the process ends right there. Alternately, the buyer can tell the seller, hey, my loan failed, but I don't want to terminate. I want to keep trying to move forward. And if the buyer just sends notice that says, hey, seller, my loan failed, but they don't also send a notice of termination, I want to terminate the contract, just my loan failed, isn't that weird, and nothing else. At that point, the next step begins. At this point, when the buyer has said my loan failed, but I don't want to terminate, we begin a mandatory renegotiation period for a 2-day period. You can set up different timelines as you wish, but I'll use the default of 2 days. During this 2-day period, the parties are expected to at least consider potential other loans that could work in this process. They don't have to agree to them, but they do need to spend 2 days cooling down and thinking about what they want to do next. If this fails, then the fullest step occurs. If the buyer is at step 3, buyer and seller agree to a different loan, congratulations, move forward with the transaction. You have a new loan to work through this process with. The financing contingency resets for this new loan. If, on the other hand, the parties cannot come to an agreement, there's the loggerheads about what loan program the buyer is going to use, the seller doesn't want to sell the house to the buyer using a different loan program, something doesn't work, and the loan never gets renegotiated during that 2-day period, At that point, the parties will have a 2-day period to terminate. The buyer can terminate or the seller can terminate, essentially saying, we tried to renegotiate, it didn't work, so we're not under contract anymore. If nobody terminates during that 2-day period, the contract moves forward without a financing contingency. This is an extraordinarily high-risk moment for both clients because for the seller, they now have a buyer who doesn't have a loan and they're just hoping things will work out. And for the buyer, they want to buy a property and they're under contract to buy it, but they don't have money to make that purchase. So the financing contingency is gone, which means there is potentially a high risk of breach at the end of the day. Now, why is it set up this way? It's set up this way because the buyer has been given a chance to terminate at the start point when they learned that their loan was going to fail. And they've also been given a chance to terminate when they find out that this loan is not going to be renegotiated. The parties cannot come to an agreement. You've been given 2 chances to terminate. If you have not utilized either of those chances, our assumption is that the buyer is still trying to make this work and is not willing to let it go. As a seller, you found out your buyer didn't have proper financing. They can't get proper financing. You couldn't come to an agreement on what financing they would use. At that stage for a seller, you want to terminate that buyer. If you don't terminate within the window you've been given with full knowledge this transaction is sketchy and how it's financed, we assume the seller wants this transaction to move forward as well. And so when both parties have missed or otherwise jumped over their chance to terminate the contract, our assumption is that this contract is one that they want to continue. As a broker, as an agent, this is the moment where you can show your worth and really have a discussion with your client. What do you want to have happen if this loan fails? Do you want to terminate? If the answer is yes, have a notice of termination prepped and ready for when that renegotiation period fails. If it doesn't work, your client will know whether they want to remain under contract or not, and you can be prepared for this. In a separate world, if you're in an all-cash transaction, there's a separate contingency process for how that cash purchase is addressed. That's done with this, the proof of cash funds section. If you are not using a loan, the buyer is still going to have to prove to the seller that they have enough money to make the purchase. That is an integral part of the transaction. And so, under this section, the buyer will have a short period of time to prove to the seller that they have enough money to make the purchase. This can be in any format that is sufficient for the parties, that they find satisfactory. It is ultimately dependent on the seller's satisfaction. So a buyer should be very intentional about how they prove that they are able to make this purchase. It shouldn't be something where the buyer just winks and says, I have enough, trust me. It shouldn't be, as we've heard happens in some transactions, where a buyer just sends a picture of a giant pile of gold coins they have in their room. In this case, it was gold bars and a stack. They said, this is what I've got to buy the transaction. It shouldn't be something that a seller reasonably says that's Photoshop, that's not real. It should be something that very affirmatively proves to the seller that you have enough money and satisfies the seller that you are not lying about the proof of funds that you have given. If the seller does not approve of this cash fund proof, they can terminate the contract. They have a right to terminate the contract. Keep in mind, this proof of cash funds should not include non-liquid assets, stocks, retirement accounts, sale of fine art, sale of other real estate, sale of anything that you have not sold yet, or contingent funds from something that you trust you'll have in the future, money you don't have yet, but something has to accrue for you to have it. It should not include that unless the parties specify that specifically. Now, why is this relevant? A lot of parties say, I am going to sell my personal house to finance this purchase. When I sell my house, I'm going to get a briefcase full of dollar bills and I'll use that to purchase this property. So that's a cash purchase, right? It's not cash yet. Until you sell your house, it's not cash, which means that is a contingent asset. Until you've sold your house, you don't have the cash. Which means if you are doing a proof of cash funds and you are saying, I'm good for it because I need to sell my house, that is a contingent fund that needs to be specified in your contract or should have an addendum with it that very distinctly says, I have to sell my house in order to have the cash to finance this purchase all cash. It would still be a cash purchase. It would just be cash that is based upon a contingent happening. And so there's additional disclosures and additional documents that should accompany that statement that you are purchasing in cash. A piece of the contract is the diligence provision. This is not an inspection contingency. This is a due diligence. The buyer is given a time period, generally 10 days. You can specify more if you wish, to do any in diligence they wish. They can look into zoning. They can look into local municipal rules. They can look into potential validity of the property for Airbnb purposes or to use as a hostel or whatever their use purpose is. Whatever the buyer wants to use this house for, they can look into it during this time frame. They can also inspect. In fact, there are several inspections that the buyer is simply allowed to do that would normally be considered invasive, but we as a baseline in the contract say they are allowed. Buyers allowed to do sewer scopes. They're allowed to do mold inspections, pest inspections, dry rot inspections, radon tests, and oil tank locations. If there is a buried oil tank somewhere on the property, the buyer can do these inspections and they don't need additional seller permission. Now, if the seller doesn't want the buyer to do any of these tests, they can exclude that. The seller can put an addendum to the contract to put in the additional provisions. Buyer not permitted to do mold tests without seller permission, not pest inspection, period. The buyer is not allowed to do these things. If you specify that, you'll modify the contract and that's allowed. But if there is no specification, the default stance of this provision is that the buyer is allowed to do all of their due diligence and this set of pre-approved invasive inspections at will. They just need to specify these things with the seller and schedule them accordingly. Now, if the buyer wants to do other invasive inspections, if they want to have someone do an asbestos test, they do need the seller's permission. That is not a pre-approved invasive inspection. Those invasive inspections that are not on the list, those require additional approval from the seller. If there is a repair that the parties do agree to at the end of this process, the diligence period ends. So you'll have 10 days to look into everything that you want to look into. And if at some point you say, seller, I want you to redo the roof. And the seller says, I agree, let's redo the roof. Your ability to terminate the contract based on a failure of the due diligence period ends. This due diligence contingency is a window during which the buyer can terminate for any reason whatsoever, any reason they want. I was looking into the zoning and I wanted to make this a bed and breakfast because that's my dream in my retirement. And I can't make it a bed and breakfast in this city, in this zone. So I don't want the house anymore. That's a reason that's valid. The buyer can terminate. Even if the buyer has no reason at all, they can terminate during this due diligence period. It is simply a period of time where the buyer can back out of the contract. If there is an agreement to repairs, where the seller now has skin in the game and has agreed to expend some of their own funds, the buyer no longer has a right to terminate. The diligence period closes. Now, wells and septic systems are off this timeline. They have their own separate track that they work with because the well tests can sometimes take a long period of time and septic inspections require some other actions that happen first, such as pumping the septic tank. And so those don't necessarily have to happen within this diligence period. They could, but they don't have to. Now, it is worth noting, because this is a window that closes, as a buyer agent, you want to make sure your buyer understands. If we get to day 10 of our diligence period, the last day of the diligence period, and we have not come to an agreement on a repair, or we have not gotten our inspection done, what do we want to do? Do we want to try and extend the diligence period? If so, we should have an addendum ready to ask that seller for an extension. And what if the seller says no to the extension? What do? Do we terminate? If your buyer says on day 10, if nothing's working, I want out, have that termination document ready. This termination must occur within the due diligence period. It is a window that closes. If you wait until the window is closed, you do not have a right to terminate anymore. And your buyer could lose their earnest money if they terminate outside that diligence window, if they're trying to terminate for some reason that they've drawn from this due diligence period. As a broker, be aware you need to be predictive in how you fill out your documents and how you talk with your client about the due diligence contingency and the due diligence period. It is not 10 days to do your inspections and then think about them. It is 10 days to do the inspection, to do the negotiations, to do the documents, and to potentially terminate if nothing works out. And they need to be ready to do all of those things within the due diligence window. With regards to the title contingency, there is a separate contingency where the buyer gets a period of time to look at the title. Within a business day after the contract is agreed to between the buyer and the seller has to order the title report. A preliminary title report within 1 business day has to be ordered. Now, when you order the report, doesn't trigger the next set of timelines, but it does set up when title should start delivering that report. Once the title report is delivered, once the buyer gets that report, the buyer has 5 business days to review and disapprove of items in that title report. If the buyer looks at it and sees that there's an easement where the neighbor can park their car in the driveway whenever they want, the buyer might not want that, and they can request, seller, I want to buy your house still, but you have to get rid of this neighbor parking easement because I don't like it. It makes me uncomfortable and I don't know your neighbor. I want you to get rid of the neighbor's parking easement. If the buyer makes some statement at that point and they disapprove, they say, seller, I disapprove of this portion of the title report, the seller is given a time frame, 5 days, to remedy those items. Now, if the seller can't get the item remedied in that time frame, they can go back to the buyer and say, I need more time. And that's fine. The parties can agree to give the seller more time. But the seller should try and get things done within their remedy period. If the seller does not remedy those items within that time frame, buyer says the title report Within 5 days, say, I don't like this neighbor's parking easement. Hey, seller, I don't like this easement. Get rid of it. The seller has 5 days. They don't do anything. They don't talk to the neighbor. They don't get anything moved, and there's no proof that they've removed that easement. At that point, seller's failure to remedy grants buyer a 2-day period to terminate the contract. Basically, the buyer knows at the end of that 5 days if they've gotten proof from the seller or not that the disapproved item has been disappeared or removed. If the seller has not provided proof that they've fixed the problem, the buyer can terminate the contract, because sometimes these items in the title report are very relevant to the buyer and they may want to terminate the contract. If that happens, the buyer can terminate. If the buyer doesn't terminate, and they don't disapprove items. So let's say you get to the end of your 5-day disapproval period as a buyer and you don't disapprove, or the seller gets a disapproval and doesn't remedy and the buyer just chooses not to terminate. We continue as though the condition is waived. We've approved the condition of title, even with that item that the buyer disapproved of. Essentially, if the buyer does not take advantage of their right to say, I disapprove, or their right to say, I terminate because you didn't fix it, the buyer no longer has a right to terminate the contract. We move forward, assuming that the buyer is okay with it. It could be a situation where the buyer says, I really didn't want that neighbor's parking easement, but I want this house more than I want to get that easement removed. So if it means I get my dream house and the neighbor parks there sometimes, I want to move forward. There is no automatic termination here. It's an act that the buyer must take if they disapprove of the property or if they find some problem with the remedies. From here, there is a section on carbon monoxide and smoke detectors. It is the seller's job under the fire marshal's laws to have smoke detectors in place before they sell the property. To meet fire codes, you have to have a specific number of smoke detectors in specific locations, and you have to meet specific standards for carbon monoxide detectors as well. If the seller has a house that doesn't have proper smoke detectors, and that somehow causes the buyer to need to do a second appraisal, happens sometimes where the bank goes in and says, we love everything about the house, it appraised perfectly, it doesn't have smoke detectors in the right places, so we can't actually fund this loan until those smoke detectors are in place. Buyer, you're going to have to send the appraiser back 2 weeks from now to go and just check the box and say, yep, all of those smoke detectors are where they're supposed to be. If that second appraisal creates a cost for the buyer, that is at the seller's expense. The seller, by signing this contract, agrees that they will pay for the cost of that reinspection or that secondary appraisal that has to happen as a result of essentially seller's house being non-compliant with state law. There's a next section here on risk of loss. If there is some reason where the property gets destroyed or damaged in such a way where it's materially different. Now, this provision essentially creates a scaffold for the parties to follow where they can say, yeah, we want to continue in the transaction and we'll try and renegotiate. It simply provides like a dotted line for the parties to follow and maybe move forward. This provision exists in large part for those properties that get caught in a disaster. For instance, buyer wants to purchase a property and then a wildfire comes through and utterly destroys 3/4 of the beautiful lawn that buyer wanted to purchase, or it destroys the porch, or it cuts part of the house, gets hit by a tree, and something material changes about the property. That could change the buyer's mind. I wanted to buy a house when it was beautiful, but now it's this burned out husk, and I just don't want that anymore. That could change the buyer's mind. There might be a reason to terminate. Alternately, the buyer might want to move forward, but your contract needs to change because you no longer are working with the same property transaction you were before. And so this risk of loss provision gives you a section to apply in that scenario, a process that may work or might not work. Parties can follow on that gives additional time for consideration and potentially moving forward, as well as options for termination if things don't work out. Under federal law, if a house was built before 1978, it's a special type of property that requires lead disclosures because lead paint was unregulated before 78. That requires both a disclosure by the seller that says, yes, I've done lead inspections and there is lead. Yes, I've done lead inspections and there was no lead, or no, I haven't done lead inspections. You have to disclose one of those 3 things. And you have to provide a pamphlet that's from the EPA. That is a seller disclosure. And if the seller doesn't do that, the EPA is not pleased with them. As a result, the contract is modified specifically based on that federal law. There is a termination right that the buyer has if the seller does not provide their disclosure or if they don't provide the pamphlet. There's similarly a termination right that the buyer gets if that pamphlet or the disclosure is provided after mutual acceptance. If the seller forgot to send the EPA pamphlet that says protect your family from lead in the home, they don't send it until 10 days, 15 days into the transaction, the buyer is given a short window of time to terminate the contract because they've gotten that document late. This is expressly to keep it compliant with federal guidance, federal law, CFRs. There is also a statutory required disclosure statement. If you are a seller, for instance, who is selling a property that's 1 to 4 dwellings, not commercial property specifically, and you as a seller are not, for example, a court-appointed trustee or a court-appointed personal representative, you have a requirement at law to provide what's called the seller's property disclosure statement, abbreviated sometimes as SPDS. The SPDS is a long list of disclosures that the seller provides to the buyer where they explain what they know about the property. Do I have marketable title? Is there a water right? Has there been a recall on the siding of the house at some point? The seller provides all that information in the SPDS, and if this buyer receives the SPDS and dislikes it and disapproves for quite literally any reason specified within the SPDS or even not specified, just disapproves of that disclosure, the buyer has a right to revoke the contract, which is a special way of terminating the contract. It essentially allows for an expedited termination and doesn't require agreement or mutual instructions to escrow. It is the Uber termination process, and it's only allowed when the SPDS is not delivered. So just be aware, if you're a specific kind of seller or a specific kind of property, you won't have to provide the SPDS, but the vast majority of your clients will have to provide a seller's property disclosure statement, and they need to know what it does. It provides the buyer with a revocation right unless the buyer has waived their right to receive a seller's property disclosure statement. Lastly, in this timeframe section, there's a provision on construction, new construction. Under Oregon law, there's a requirement that certain properties that are new constructions or have $50,000 in renovations or in contract cost of renovations, $50,000 or more, that they have to receive certain disclosures and certain protection. This provision essentially says if your property has one of these things true about it, it's a new construction, it had certain renovations of certain value that happened within the last 90 days, then you gotta provide this additional form that covers additional protections to keep you compliant with Oregon law. From here, we're in the general terms section. This is kind of the broad section information that'll cover all kinds of stuff within the contract. We begin here with the section on definitions. All capitalized terms within a contract are typically going to be a defined term. If you see a word that's capitalized and seems irregular, it's not the first word in the sentence, for example, that's probably a defined term. For example, the word promptly is defined within the contract. If you ever see a capital P, promptly, it means as soon as practical, as quick as you can, but in no case more than 2 business days from now. So if I say you must promptly provide your earnest money, that means get your earnest money to me as quick as possible, but maximum window 2 days from now. You get 2 business days at most, but I would be very pleased if you would do it faster. So that term promptly is defined. What that means is anytime you see the word promptly, you could replace it with the words as soon as practicable, but no more than 2 business days from now. These definitions allow for the contract to be a little bit more concise and to use a little bit more specific language. And I would highly encourage people go through the entirety of the definition section and become very comfortable with the terms. They are very straightforward ones. Actual knowledge. What does it mean to actually know something? What is a business day? What is closing mean? What is the effective date of the contract? And so on and so forth. But you need to know these defined terms because they are going to be in many places within your contract. From here on out, there is what you would sometimes consider kind of boilerplate language. It's relevant. It's largely there to create a contract in classic sense. For instance, there's a section on headlines and a section on descriptions that essentially says if it's in the headline, it's meant for informational purposes. It's usually just describing the document, telling you how to read the contract, how to understand it. It's not a legal definition in many situations. So just be aware, a lot of this is just informational stuff. You don't have to necessarily follow when it says like-kind exchange. That doesn't have to do a 1031 exchange with every property. It's informational to tell you how to understand the contract. There are some items, for example, included items and like-kind exchanges that are going to very specifically lay out how parties are able to do things. Hey, just be aware, you can include other items in this transaction. It doesn't have to follow the fixture stays with the buyer, the personal property stays with the seller rules. You can deviate from those, but this is the default if you don't deviate. You can do a 1031 exchange. You don't have to. It lays out the options of the parties. So some of the boilerplate will tell you how to read the contract. Some of the boilerplate will establish optional rights of the parties. Some of the provisions are going to express a party's understanding of the contract itself. This is the representation. Additional seller representations. They say, I, the seller, for example, have marketable title. I can sell this house. I am guaranteeing to you, buyer, that I have the right to sell this house. Doesn't seem that relevant for a lot of folks, but for example, if the seller is trustee of a trust, they are sharing the trustee duties with 6 other siblings who all own that property together and they want to sell the house. This seller, this one trustee, might not have the right to sell. They might not have unilateral rights to bind the entire trust, and it depends on what the trust itself allows. So what that means is if the seller signing this contract, they are guaranteeing to the buyer, I have the right to do the following things, including selling the property. I have a right to be able to bind this contract in some way. It allows the seller to essentially lay out their promises, and it lets the buyer hold the seller to those core promises to the contract. There are similarly buyer acknowledgements about the condition of the property. I, the buyer, understand that I am buying a property in as-is condition. The condition it is at the moment I put in my offer. That is the property I buy. So if I don't like the condition of the property at present, I need to contract to improve that. If I'm buying the house and the furnace has a month of life left in it, I understand that I am getting 1 month of life on a furnace. That's the extent of what I'm getting. It allows the parties to essentially bind the other person to a representation that they say, I do understand what I'm getting into. I do understand what I'm holding myself to when I sign this contract. There are provisions in here. For example, the proof of funds section lays out the default for how money is going to flow, but it does allow the parties to specify alternate flows of that. You can have, for example, a proration that occurs in a specific way, in a specific date, or in a specific manner. You can have a proration where the buyer is paying for all of the utility costs that occur immediately upon effective date of the contract to just sweeten the deal. You can do all sorts of things, but there is a default. And this section lays out the default if you don't specify otherwise. Similarly, closing costs are specified as well. Here are the things the buyer will pay. Here are the things the seller will pay. You can agree otherwise, but this is the default stance if you don't change anything else in the contract. The buyer will pay for costs that accrue after closing. The seller will pay for costs that accrue before closing. If you have a city that sends out a notice that you need to redo your sidewalk and it's going to be the homeowner's expense, the seller is the one responsible for that homeowner expense before closing. If the buyer gets that notice after closing, the seller is not responsible for that. That's a buyer cost. You've already closed the transaction. This section specifies who's responsible for what after or before closing and who pays which part. This next piece is the closing, property condition, cleaning of the property, state withholdings. There's certain tax pieces that apply. At closing, you'll have all kinds of things that must occur. And closing can happen at or before the closing date that's specified earlier in the contract. If the county recording office is closed on the day you were supposed to close, you can't record, which means you can't transfer the property. So closing is not possible on that day. As a result, if there's some problem where the closing date is impossible to actually occur, the contract automatically moves that closing date to the next available day where it could be closed. There's additional provisions in here where the seller is expected to provide the property in the condition it was at the time of the offer. So that means the seller is expected, for instance, if the house has washing machine that works, if the washing machine breaks because the seller in their last day of the house decides to wash all their towels at once and they just break the machine, the seller is expected to fix that item because it was in the property in the condition it was when the offer was made. If the washing machine was part of the transaction and it was expected to be in the condition it was at offer, the seller needs to ensure that that is the case, or otherwise needs to compensate the buyer to meet whatever that requirement was. There's a requirement that the seller keep the property clean to a certain degree. Cleaning is a loosely defined term. Everyone has a different opinion of clean. If the parties have very specific feelings about what clean means, specify it in your contract. And it also specifies in this section very distinctly, if you leave things behind, seller, that were otherwise supposed to be yours, personal property that was supposed to be yours, and you leave it behind, it belongs to the buyer. Unless the buyer needs to trash that stuff and get rid of it, at which point, seller, you're responsible for the cost of getting rid of the trashed objects. There's a famous case in Oregon where a person left behind wads of money in the attic. That's the buyer's money now. Case law supports that. You left it behind, it belongs to the buyer. Sorry. If you leave behind a junker car that the buyer has to pay to get towed away, seller, that's on you. The buyer can pursue those costs against you in a dispute resolution later on because they have incurred some expense from the seller leaving stuff behind that the buyer didn't want to have. The contract has a provision in here that lays out the process for default. This exists at common law, but we specify it within the contract to hopefully add more clarity. There will be performance obligations within your contracts. Contracts tell you things you are supposed to do. They will say when you have to do an action. Buyer needs to do the following thing, needs to provide notice by Wednesday this week. That performance obligation is something you are expected to do because you've agreed to do it through contract. If the contract performance obligation says the party fails to perform, you can terminate. That's great. It tells you exactly what to do. You can go straight to termination because it has told you you can do that. If the contract doesn't provide guidance, it just says buyer needs to provide notice by Wednesday and provides no other guidance. Maybe it's a material problem if you fail, maybe it's not. As a result, the clean process that we've provided here is if there's a performance obligation, a party, buyer, or seller has to do something and they don't do it, and the contract doesn't tell you what you can do if they fail, send them a notice of default and say, hey, other party, couldn't help but notice the contract told you you had to do the following thing by the following time frame, and you failed. So I'm going to give you a cure period. Please fix it. You originally contracted to do it by Wednesday. I'll give you till Monday next week. If you get it done by Monday next week, congratulations, no problem. If you don't get it done by Monday next week, we can now very affirmatively say, this is a material breach of the contract, and I want to terminate, and I want my earnest money because you have failed the contract as you contracted to do, and you failed a second time after I notified you about it. So by sending a notice of default, you can encourage a party to get back into compliance, or otherwise guarantee that the default is a material breach that otherwise is not fixed. This default notice doesn't have to be sent when someone defrauds you. If a seller doesn't actually own the property and they were lying to you about that and they don't have marketable title, you don't have to send them a notice of default and say, you've got 3 days to get marketable title so you can actually sell this property that you were lying to me about owning. You can just move straight to the frauding scenario if the cure is physically impossible to do. Like literally impossible. This means as impossible that in your wildest dreams you could not accomplish it. For example, the buyer needs to give the seller 30-day notice of something, and you are 20 days in, and you only have 10 days left in your transaction. The buyer does not have any ability to give 30 days notice. It's not possible because you simply, that time frame cannot be accommodated. That's material. Someone has failed their task, and therefore you can move straight to termination. If the contract says you can go straight to termination, you can go straight to termination. But if the contract is silent, if you're unsure what to do, you can send a notice of default. Now, you don't have to act upon a notice of default. You can just send it. Have a prod the other party. Hey, I can't help but notice you have agreed in the contract to do the following act, but you didn't do that act. Please do it. I don't have to terminate if you fail to cure. I can, but I don't have to. That's the benefit of the notice of default. It is a negotiation tool. You're letting them know that this thing they aren't doing, it really does matter to you, and it might matter enough that you'll terminate the contract, and they know that now, but you don't have to terminate the contract. Separately, if you do wish to terminate the contract, there's a process for that. You can send a document that says, I refuse to continue in this transaction. I'm sending you a notice of default. I no longer wish to be contracting with you. In the interest of not relying on common law, because there is technically a way for terminating at common law, we lay out a specific process for termination that makes it very structural. Common law termination, abstract law process exists, but we don't necessarily want to rely on it because it requires more of a legal understanding than we necessarily want to integrate into a consumer transaction. The termination itself is allowed when the contract tells you you can terminate. Go straight to termination, no problem. Termination is allowed when someone misrepresents a material fact. So for example, I have marketable title. If you don't have marketable title, that's a material lie. That is big fraud, and that's a reason for termination. Or when the condition of closing is unfulfilled by closing or otherwise impossible to do that thing. And when we say impossible, we mean like really impossible. Like if you were the president, pope, and king simultaneously, you couldn't get it done. It is straight up impossible to get this thing done. If any of those are the case, you can terminate. Now, notice we don't have default goes uncured. That's because if the default goes uncured, the contract allows you to terminate. So it's technically under subsection 1 for when you're allowed to terminate. That's what default's allowed. Performance obligations do come to an end when you send your notice of termination. If I send a notice of termination, I no longer have to continue acting on my contract. The contract is terminated. Now, if I terminate improperly, if I send a notice of termination when the contract doesn't let me do so, I just say like, well, I don't like this buyer now, so I'm terminating. The contract doesn't let you terminate because you don't like the buyer. So that means that you as the seller have terminated improperly. And that may mean that the buyer has other rights where they can sue for remedies, for costs and damages incurred. The buyer could potentially sue for specific performance and undo your termination. Your termination would not occur at that stage. Or in some cases, the buyer may just allow the termination to continue. So it's if you terminate improperly, your performance obligations are technically ended, but you could be in some hot water if you do things wrong. Escrow under Oregon law does require that they have instructions from both the buyer party and the seller party before they can disperse the earnest money. So if there is a dispute, if you terminate, contract performance is over. But you also need to get escrow instructions from the other party. Otherwise, escrow is prohibited at law from sending it out. There are ways that escrow can get around this with a court order, for example, or with agreement between the parties. What that means is if I terminate the contract, I send you a notice of termination, I will specify where I think the earnest money should go. You need to provide a response that has your thoughts on where the earnest money should go as well. If you say, I think the seller should get the earnest money, and I say, I think the seller should get the earnest money, escrow can act. They have matching instructions. They can disperse that earnest money. If you say, buyer should get the earnest money and I say seller should get the earnest money, we disagree with each other, escrow at Oregon law is prohibited from dispersing that money unless there's a lawsuit or the parties agree on something. So the notice of termination ends the contract, but it doesn't end your dispute over the earnest money. That can persist sometime after the contract is actually terminated. And that does create this kind of awkward two-rail process that exists at all times, but that's simply a result of how escrow is bound by Oregon law. If there is a revocation of the contract through the SPDS, this means the buyer has received the SPDS, and within 5 business days, they say, I don't want to do this contract. Oregon law allows escrow to just send the money back to that buyer, to refund the money. They don't need a response for the other party. The seller doesn't have to do anything. If buyer says, I disapprove, and they send in their revocation document, it's over. The whole process is over. Escrow doesn't need anything else. You can just end the contract outright. Now, if there is a termination, the contract specifies where earnest money is generally supposed to go. The parties can agree otherwise, but this lays out the general default pathway for earnest money refund or earnest money retention after a termination. Most situations will say the buyer gets the earnest money back. Some situations will say the seller gets to keep the earnest money. If there is a failure to act on a notice of default, the party that sent the default, the non-defaulting party who's basically notified the failing party, they get to keep their earnest money or get it back. So if you are a seller who sends a notice of default and the buyer doesn't cure, you get to keep the earnest money under the way the contract is written. If you're a buyer who sends a notice of default and the seller doesn't cure, you get your money back as how the contract is written. This provision will essentially lay out how the parties can recover earnest money in one of these scenarios where termination occurs. The seller does also agree in this section to a liquidated damages sum, which means the maximum amount the seller can receive or recover if there is a termination is capped at the earnest money amount. Now, a buyer, the sky is the limit. The buyer has the ability to sue for damages that they've incurred in this transaction. So if the buyer sells their house and moves into Oregon, rents a hotel, and all kinds of other reliance damages, they may be able to sue the seller if the seller suddenly backs out of that offer and costs this buyer a huge amount of money. That's something the buyer can sue over. The seller does not have that same right. If the seller has expended a ton of money packing up their house and spent some time in a motel, they get to receive the maximum of the earnest money. This is a typical process for real estate transactions. It's called a liquid damages sum. It puts a ceiling on the seller's recovery amount, which means if you are a seller, and if you're an agent explaining this to your seller, your earnest money amount should be representative of what you feel comfortable with in one of these scenarios where a buyer backs out. If you feel like you are entitled to a large sum of money, your earnest money sum that you expect in this contract needs to reflect that. That may mean that some sellers want to counteroffer to raise the earnest money sum because they are more uncomfortable with buyer in this transaction or they want more skin in the game. If that's the case, that would be something you would handle with a counteroffer, but make sure you discuss this process with your seller because they need to understand how liquid damages operate. If there is a dispute between the parties, this provision holds. The dispute resolution provision addresses all of the conflicts between the parties. So if the buyer and the seller disagree about a contract term while they're under contract, this is what you would use to address that dispute. If a buyer and seller close and then the buyer feels like they got a raw deal and the property is not what they expected, this is the provision that addresses that dispute. All disputes that happen after mutual acceptance with relation to this transaction and this property are handled based on this resolution provision. It lays out kind of where you can argue and when you would use the dispute resolution provision. There are some things you won't. For example, if it's a probate issue, probate court handles that. If it's an eviction, there's a process for that happens in court. If there's a small claims court proceeding, it's not something that you would do through arbitration or mediation. You do it through small claims court. The way that we've set up the contract is that the issue is first taken to small claims court if you can. Small claims court is an expedited court process where typically the parties don't have representation. They don't have lawyers involved. They simply are explaining their case to the judge who reads the contract and makes a decision. Small claims court is only available if the issue is just money and it's $10,000 or less. So if you are fighting over $11,000, if you are fighting over whether or not the buyer should get specific performance, small claims court cannot handle it. And if it can't be handled by small claims court, you would take it to Arbitration Services of Portland, where you would first mediate the process. You would have a neutral third party that would sit down at a table with the parties or sit down separately with the parties and gather what their position is, this dispute, and try and come to a solution that both parties can accept. And if nobody can accept the outcome, you would go to arbitration, where you do functionally the same thing, but at the end of the process, the arbitrator provides an answer that the parties will be bound to. Essentially, if you can't take it to small claims court, go to mediation. If you can't figure out a mediation, take it to arbitration. At arbitration, you will have a final answer, and that final answer is something that can be affirmed in a court or ratified by a court, and that arbitration order affirmed by a court will allow escrow to send out the earnest money. So if there is a dispute over anything in the contract, over earnest money disposition, over anything related to this contract, the dispute resolutions provision is what will apply. This last chunk is what we would just literally describe as boilerplate. It's stuff that you should really have in a contract or have to have in a contract, but its impact is not necessarily going to be present in every single transaction. So, for example, a contract is not assignable unless the parties agree to that. The parties can agree that the buyer can assign things, or if the buyer puts in their offer, buyer and or assigns as the name of the buyer, so like John Smith and or assigns. If the seller gets that offer from John Smith and or assigns, they understand that this is an assignable contract. That means that the buyer could potentially sell this contract to somebody else later on. Their son could take over the contract. They could sell it to their neighbor. They could just sell it broadly. This provision in here on assignment allows the parties to specify that they are so-and-so and or assigns, and that'll simply make the contract assigned. There's a provision on what you do after somebody dies. If a party dies, their heirs or an estate inherits the agreement. Now, what this generally means is if you're a seller who's midway through the contract and you die, your heirs, your administrator, your spouse, your children, whoever it is that takes over your estate, has to follow through with the contract. Generally, the seller is bound by a contract more affirmatively because if the seller breaches, the buyer can pursue specific performance and demand the effective, successful completion of the contract. So the seller's estate will typically have to carry on the contract. Alternately, if you're a buyer who's midway through a purchase transaction and you die, your heirs are able to decide whether they want to continue the contract or not. If they say no, they may be sacrificing the earnest money. They may be just losing the earnest money, but they don't have to be in a purchase transaction as an estate of a decedent buyer. For the buyer's estate, this means they have more flexibility and can more often than not back out of a contract when the buyer dies if they don't want to actually purchase that house. But it does mean that they might be losing the earnest money. For a seller, it generally means that your estate is going to be bound to sell this property as part of the estate process. There's a provision in here that specifies that timelines are always essential. This means anything that has a date is going to be a material term. If I say you need to do it within 3 days and you don't do it within 3 days, that's a material term and it would always support a termination. We still would encourage the no use of the notice of default because it encourages contracts to actually succeed. But theoretically, at any time where there is a time frame specified, that time frame or that date is a material element of the contract that would undergird or support a termination. There are provisions that are severable at law. All of the contract is severable because of the severability provision, which means if, for example, something changes in the Oregon legislature and immediately today there's something new about the law that invalidates a provision of our contract. Let's say Oregon's legislature says suddenly you are no longer ever allowed to assign a real estate contract. The severability provision says, okay, great, your real estate contract is still valid. The one thing that no longer applies is the assignment provision because the law changed. We can clip that one little piece out of the contract and get rid of it because it's severable. If you don't have a severability provision, there's a question about whether or not the contract is valid as a whole. If anything goes wrong at a legislative level, if there's something minor, there's no longer, you can't assign contracts anymore. Well, we weren't doing an assignable contract, but there is an assignment provision. There's a question of whether that's valid or not. So we put in a severability provision as a boilerplate to essentially avoid the dispute or argument that could come through the statement that there is a provision that's non-applicable that somehow invalidates the contract. There is a provision in here that is a non-waiver provision that says essentially if you ever don't act on a contractual right, it doesn't mean you've given away that right to act on it forever. This would be a situation that's the easiest example of that would be, for instance, you have a tenant in a house. That tenant pays rent monthly. You don't collect their rent this month. You don't collect their rent next month. You don't collect the rent the third month. The fourth month, you want to collect rent. Yeah, at law, the tenant can argue, well, based on our interactions, I didn't think you were collecting rent anymore. It's a weak argument, but it can be made. With a non-waiver provision, you can simply say that's not how this works. Each individual breach of the contract is a full breach in its own right, and if I don't act upon the first one, that doesn't stop me from acting upon the second, third, fourth, or subsequent breach. Modifications are allowed, but they're only allowed in writing. These contracts cannot be orally modified. You have to have an addendum or a contract that modifies it. And lastly, digital signatures are valid counterparts. It essentially allows you to use DocuSign to make this thing. Back in the old days, you had to send one physical copy of a document from place to place to place, and everyone had to put ink on the same document. We don't live in that world anymore, and we don't need to do that. At the very top, I skipped over this one, but let's just talk about it. That's the mandatory statement. It's required by Oregon law. You have to put that in every single real estate transaction document. It essentially says this property could be in a fire district. It could have some zoning stuff going on. It could have some land use provisions that apply. You should look into it if it applies. Broad statement just essentially says, think critically before you sign the contract. Here at the very tail end of the contract, you have a section where the buyer's offer is give it an expiration date. You should put in a specific time frame and a specific day. You have to accept the offer by 5 p.m. on Sunday the 6th or something along those lines. You can put the date at whatever you choose it is. It doesn't have to be a business day, but we would encourage business days in general as a professional courtesy to your peers who sometimes might not be working on weekends every single weekend. You would then have the buyer's ability to sign the contract. If the buyer agrees with all the terms of their own offer, which they typically should, it's their offer, they would sign this and provide a date and time. I, buyer John Smith, sign the contract, date and time, June 1st, 2025, whatever ends up being. You then pass it along to the seller. The seller has the ability to say yes, they have the ability to say no, and they have the ability to counteroffer, which is effectively them saying no, but. If a seller counteroffers, you continue the process. At that point, the buyer has the right to accept, reject, counter. If seller rejects outright, the contract is technically dead. This contract does not come back from a rejection. It's over. If the buyer accepts, they have to accept it when it has not yet expired, and they should sign the contract. Part of this process is checking accept and signing the contract. Just a signature is not necessarily going to be indicative of the acceptance, because we did have situations where sellers would on DocuSign just punch a whole bunch of buttons and say, I reject the contract. And they did sign it through the punching of documents, and that's a problem. So to make it very clear, the seller only can accept if they check the box that says, I accept, and sign their name and date. And then right at the very end, for informational purposes only, you have a section where the broker can say, on this day at this time, I presented this offer to my seller. It allows you to essentially check your paper trail. And if OREA does ask, have you been presenting the documents and offers as required? You say, yes, I have. And I can show you this is exactly where and when the time frame that I presented my offers. And that's the whole of document 1.1, the residential sales agreement. Addendums will make this more complicated as time goes on, but that is the core, the hub of the document. All the spokes that spread out from there, you can then add as needed, but it's always going to be your sales agreement at the core of your contract.